rupees. That's a big upside to the current market price. So that's another stock that perhaps you'd want to look at this morning. In fact, lots of brokerages, right? There's Adani Ports, where Goldman Sachs has raised their target price on Adani Ports to 855 rupees on the back of very strong volume growth that Adani Ports has seen. So that's another big mover in trade. CLSA has a sell call on Jubilant Foodworks with a target price of 503. So that there is some, pressure that they're seeing in the pizza space that's being challenged by new competitors. So Jubilant Foodworks slightly in the red this morning. But as we head into the first tick on the index, just remember that this is a market where the direction has been positive. The momentum has slowed down a bit, but the Nifty is just 2% away from all-time highs. So we're virtually at all-time highs yet again, and the buy on dips is something that has worked. This morning, global cues are also positive, but we do have the Thanksgiving holiday later, so the US markets are shut tomorrow. But here's the first tick on the index. The Nifty is up about 26 odd points. The Sensex is up almost 100 points. So clocking on the green line this morning, the mid-cap index is up 124 points. Bajaj Auto is your top gainer this morning. By the way, on Bajaj Auto, my colleague Hormuz very helpfully tells us that this is Bajaj Auto's best year since 2010. It's up 60% this year, and it was up 75% way back in 2010. So it's been one of the best years that it's seen in the recent past. So keep an eye out on Bajaj Auto. Apart from that, Adani Ports, we mentioned that earlier, up 0.7%. Power Grid, Asian Paints, M&M. In fact, all auto stocks doing well this morning. M&M, Tata Motors, Eicher, Hero MotoCorp, Bajaj, all in the green right now. On the downside, Cipla, HUL, Maruti Suzuki, Ultratech Cement. By the way, mid-cap index is also opened at record highs, so looking pretty smart over there. Britannia, HDFC Bank, Kotak Mahindra Bank, just a tad bit in the red. So largely, you'd have to say all the action is now shifted to the broader markets. Take a look at Honasa, and you will come to know how the market is receiving those numbers. Good set of numbers coming in for Honasa this morning, and the stock is up about 5%.
Well, that's right. Sonia, Home First Finance, Abhishek had told us, is likely to be a large trade. That's got cleared out. That stock, in fact, is under pressure post that large trade. 10% equity nearly changing hands. So that's one stock keep an eye out on. Man Infra, well, they've announced on the exchanges a few minutes ago that they'll be meeting on November 29 to consider raising some funds. So for the time being, that stock is up close to around 10%. Will require further details out there. NMDC sources tell us here at CNBC-TV18 that they've gone ahead and they have increased prices by 200 to 300 rupees across products. So that one as well mildly higher with a gain of close to 100%. CE Info Systems, well, that's the one, Mapma India. That one, in fact, is... I think it was mildly higher in pre-open. They're considering a fundraise. In fact, it's up close to 3.5%. And Genesis, they have partnered the Survey of India for 3D digital twin mapping program in India. Yesterday, the stock was higher. Today, in fact, the stock is up only around 1.5%. A few more names that you should keep on your radar. A few stocks actually that are seeing very, very high volume moves. One is RateGain. That stock is down close to around 7%. Suzlon for another day, it's in fact low. It's down close to around 4.5%. Remember, some of these stocks have seen a big run, and now they've come for selling. Even Apollo Microsystems, the stock was up more than 40% this month. Now there's no exit actually because there's big selling out there. So that stock as well, Apollo Microsystems, that stock is down 5% and it's at lower circuit. Prashant.
Okay, well, it's not a bad open, right? I mean, 35 points or so. 19,845 is where we are at, and it's looking pretty okay. Now, just a quick few more names. CG Power, we were just highlighting that volumes are up and running, and how. CG Power is up another 5% after yesterday's 20% pop. It's the top volume traded gainer, almost 3.5 million shares on CG Power at the word go. So that's humongous. IEX, I think Vivek was mentioning IEX earlier. 3% up on IEX. Stocks at about 148. There is Man Infra, which is up 10%. It's coming up with huge volumes, Man Infra, fundraising, 175 on Man Infra. Honasa, where the management will speak with us in just a bit. I think we mentioned this, 6% higher. Results have been strong, 375 on, that's Honasa Mama Earth. Sorry, I mentioned Bajaj Auto. Of course, we had Rajiv Bajaj with us yesterday in a pretty exhaustive interview. We'll play sound bites of it later. CDSL is up about 3.5%. EID Paddy is up about 3%. There is Godrej Agrovet, which is up about 3%, and so on and so forth. I mean, it's right out of the gates. There is no dearth of volumes. Volumes are strong, and I think it's looking pretty good. Tube Investments is down 6%. It went up sharply along with CG Power and Carborundum, etc. But this morning, I think it's down, 5% or so on decent volumes. And of course, I think some of the others we've already been highlighting, so I won't go into details. KEI is down about 2.5%. E-Clerks went up sharply yesterday. E-Clerks is down about 3% or so. Shanti Gears was up 8% yesterday by close. Shanti Gears is pulling back some 4%. So these are just pullbacks off of yesterday's moves that we are seeing, all with decent sized volumes right at the word go at least. Gautam Shah is with us. He's our market master today, founder and chief strategist at Goldilocks Premium Research. Gautam, good to have you with us here. Good morning. Prashant this side. You know, the Nifty has been, of the lows of October, markets have done well. But are we running into some traffic now? What's the sense? Especially this divergence with what's happening on the Nifty Bank. How will it resolve itself in your opinion?
Good morning, Prashant. Well, indeed, it's been quite a diverging market. If you look at the last couple of weeks, it's been a big global, short covering kind of a rally, because it's not just India, but every other market in the world has seen just such a smart rally, and therefore India has also been a participant. But I think the quality of this rally has really been questionable, because most of the gains have come by way of gaps. And I think intraday strength has just not been there for the index and for the large caps. And because we are living in a disconnected world for the equity markets, probably for the first time in a long, long time, you have a scenario wherein the Nifty, the Bank Nifty, and the top 100 stocks seem to be underperforming, seem to be in a phase of indecision. Whereas if you look at the broader markets, there is a lot of momentum, there is great outperformance, and obviously there is a lot of liquidity as well. So I'm not a big bull on the Nifty and the Bank Nifty. I don't think they're going to go places from current levels. I think they're just broadly going to stay in a range. 19,850 area seems to be a very important resistance. If we were to get past this number on a closing basis, there could be some uptake, but I don't think that the markets are going to easily sustain at higher levels. But I think the real opportunity is clearly in the mid caps and small caps. I think one has to play themes. One has to just forget the Nifty and the Bank Nifty, play themes: sugar, fertilizer, insurance, auto ancillary, infra, PSU. I think that's where money and wealth is being made, and that's where one should focus on.
All right, and there are plenty of themes which are working out this morning. One space that's looking pretty good is all the companies that benefit from lower crude prices, right? So today as well, JK Tyres, for example, is up almost about 3% odd. You have something like a Berger Paints, which is up almost about 4% odd. So all the companies that use crude as raw material, they're seeing big moves this morning on the back of that 4% fall in crude overnight. Gautam, hi, good morning. So tell us about the big trend that you see in 2024. Sectorally, stock-wise, which are the stocks that could be the leaders in the next rally?
Well, Sonia, how things have changed in the last 3 weeks. While we were at the doors of 18,800, I think the scenario was very different. And now we are at 19,800. Obviously, things have changed. People are a lot more optimistic. Now, it remains to be seen how this pans out, because between now and, say, May 24, we do have a lot of headwinds. We do have events to look forward to. So I don't think the index is likely to do anything special. You broadly stay in a large range where you keep finding supply at high levels and you keep finding support at lower levels, given the liquidity angle and India's outperformance, in the global equity basket. However, having said that, in terms of themes, I think over the next 3 to 6 months, IT and pharma are very big themes. I think IT has seen a good comeback in the recent past, and I do see great upside, maybe 15 to 20% upside on the index. Pharma, as we speak, is at lifetime highs and still looks excellent on the charts. Most of these top line stocks, I think, could see anywhere between 10 to 20%. And mind you, these are the kind of returns which I don't see on the main headline indices, the Nifty and the Bank Nifty. So IT, pharma, auto, and PSU, which continues to be an existing theme, I feel would be the star performers between now and, say, May 24.
Okay, all right. Hi, Gautam. Just give me a minute. I just want to focus on a couple of stocks. Suzlon, the stock that we were talking about, was down close to 4.5%. That's done a U-turn, and that's a big volume spike that you're seeing out there. So that one as well should come up for you. Railtel as well, suddenly that stock as well has spiked up. So a few of these names, they're moving higher, and they're moving with good amount of momentum. Well, Gautam, you were talking about 19,850 and that being a crucial mark. For the time being, we're holding above those levels. So if we breach this mark and we sustain over here, last week's high was 19,875. Where do we go? And till when does this uptrend intact? I mean, on the downside, what's the level we look at on the Nifty?
See, on the downside, very clearly, 19,450, 500 has become a short-term base. So till we are above this number, I think the bulls have some control over the market. So I think that could be used as a trailing stop loss for traders or for positional investors. But I think 850 clearly on a closing basis, 850, 870 area broadly is a very important marker level based on number of technical studies, the moving averages, the trend line, the patterns that we follow. And if we do get past the same, then I think the bulls will consider themselves lucky to possibly take this market back to the previous highs. But as I said, these are days wherein we don't even look at the Nifty and the Bank Nifty, because my bigger problem is that there is no contribution from the large caps. If you look at Reliance, HDFC Bank, ICICI Bank, ITC, L&T, these are some of these big names which haven't participated in this 1,000-point rally. So the breadth among the top names hasn't been all that great. And that's probably the reason I feel that till the Bank Nifty itself does not start to do well and outperform and start trading above 500, I don't think the Nifty is going to do anything special.
Okay, you said auto, pharma, IT, right? These are a couple of spaces that you like, auto ancillaries as well, till May of 2024. But some of these spaces like autos have rallied so much. I mean, we were just talking about how Bajaj Auto, TVS Motor have seen their highest gains in over a decade, right, in a single year. Do you think there is still more scope for them to build on to these gains?
I think there is a lot of scope even from current levels. We have seen a lot of rotational correction in the market. This is very unlike 2003, 2007, when the markets got into a corrective phase. What happened was everything fell for the time being because the Indian markets was driven by foreign money. And now because it is driven by domestic liquidity and domestic money, sticky money, what's happening is that wherever any pocket turns overbought, it goes through a correction just for the short term, but whereas the other part of the market is strong. But coming back to your point on auto, I think even currently, if you see, there are certain stocks which still stand out. While Bajaj Auto has clearly been the star performer, I just get the feeling that some newer stocks might join the party. So a Maruti can do very, very well from here. A Hero Moto seems to be coming out of 12-15 months of underperformance. That's a stock, which could potentially be a dark horse over the next 6 to 12 months.
Oh, okay. That's Hero MotoCorp. Got it. It has been actually a big underperformer. There's not too much of a technical history for many of these names, but some of these new age businesses, new listings have done pretty well, right? Honasa, of course, is the latest one. Perhaps it still needs to prove itself. But some of the others have also come back in a big way, whether it's Zomato, whether it's Nykaa, not so much. But from this entire lot, does anything stand out for you technically?
One and only, Sonia, that's Zomato. I think we've been a big bull on it for many months now. And I do believe from a technical and from a fundamental standpoint, and given the kind of institutional action that it's seeing, it's probably one name that could continue to do well over the next 6 to 12 months. So we remain very, very positive there. Among the other businesses, you need to be a little careful because I think, everything is being written with the same pen. And I don't think that's the correct way to look at the markets. But even if you look at the small cap and the mid cap space, there are so many stocks which did nothing for a decade and now seems to be breaking out. Look at real estate, did nothing for 10 years. And as the breakout has happened, look at DLF, Oberoi, Prestige, Brigade. I think this is a structural story that will continue. Fertilizer is another space that we like. So I think the top stocks like Chambal could do something special. And with Tesla's entry into India, I think auto ancillary could be a very interesting space as well. So we are watching that closely. And insurance, as a basket, hasn't been doing well for the last couple of years. It just seems that the time is right for stocks like SDFC Life, ICICI Lombard, SBI Life to see a special move over the next 6 to 12 months.
Okay, all right. Well, another important factor from an Indian market perspective, Gautam, is crude oil prices. And we are happy to see that in the last 45 days, Brent crude has corrected from about $97 per barrel to around $80 per barrel. How is it looking on the charts? Where do you see this one headed?
Well, Nigel, who would have thought? I think we lived in a world of serious geopolitical concerns. And typically, if you looked at history, you would have expected crude to actually inch towards 3 figures. But then it's seen this drop. And that's the kind of world that we are right now. I don't see much downside. Yes, it's been a bit of a dip, but I think NYMEX crude somewhere around this 70 to 75 zone, should find solid support. So broadly, 70, 90 is the sort of range that it's going to trade in. But the bigger trade for me over the next 1 year, and I've been maintaining this stance, is gold and silver. I see gold and silver breaking out and challenging equity market index returns over the next 1 year. I wouldn't be surprised if gold takes out 2070 and moves towards 23, 2400, and silver eventually in international terms goes towards 28, 29. So that's where, we are quite positive, and we would recommend your viewers to top up as well.
You would recommend our viewers to top up as well. Is the for equity indices, Gautam, is the road clear in the MSCI World Index, etc.? How are things looking there?
The world is not too clear. It's quite hazy. In fact, if you look at the MSCI World Index, MSCI Emerging Market Index or the developed world, it's just that this 2-week long snapback rally that we've seen, it's giving everybody the feel that everything is, well in this world because yields have cooled off, inflation has cooled off, the fundamental triggers that people are talking about. But I don't think it's as rosy as it seems in terms of price action. So I think indices around the world will remain a little challenging, but I think the real opportunity, not just in India, but world over, is in themes and in stocks. I think that's the world that we are going to see over the next 6 to 12 months.
All right. We'll let you go on that note. Thanks a lot, Gautam. Always great speaking with you. Thanks for joining us on the channel. That's Goldilocks Premium Research. Very optimistic on the market. By the way, he was saying one big theme that everyone should be looking at is the auto ancillary space. And that has been doing really well. Minda is on our radar now. Q2 was very strong for the company. It reported its highest ever quarterly revenues and strong growth in the domestic volumes. It's growing its electric vehicle business as well. Sunil Bora, the Group Chief Financial Officer at Minda, joins us now to discuss their business outlook. Sunil, thanks a lot for joining us. At the analyst call, you folks were mentioning that the domestic volumes have seen a 14% growth quarter on quarter. So demand continues to be very strong. But I'm just trying to understand, this double-digit mid-teens volume growth, is it something that is sustainable in the second half of the year as well?
Sonia, as you know, it's very difficult to say whether volumes will continue, but current momentum, I can say that it has maintained because after the festive season, we know that the marriage season has kicked in and that has kept the demand momentum. Also this year, the festive season also was a little bit delayed compared to last year. So if you factor that, actually, Q3 or last Q3, we are expecting significant improvement. And as far as H2 of the rest of the year goes, yes, we are pretty confident that from our perspective, we do expect the kind of growth momentum we have built in past few quarters to continue in Q3 and Q4 as well.
So when you say momentum that you've built will continue in Q3 and Q4, I don't want a number from you, but just trying to understand that this 14-15% growth in the volumes is something that you can replicate, or can you even do better than that? Because, a lot of the other businesses, a lot of EV-related businesses are picking up now.
No, Surya, we can definitely do better than what we have delivered. We are consistently building our capacities, but as you know, that our 90% of revenues is linked to the industry volumes or the OEMs. So whatever the industry volumes, we have to serve it. And our B2C segment, which is our aftermarket, is just 8 to 9%. So from that perspective, we have been consistently building our capacities. And in case there is any volume uptick or whatever industry needs, we are fully geared up to meet that demand.
All right. Hi, Sunil. Good to see you in after a while. Well, EV is the key focus, right? And there have been so many JVs. It's getting a little bit competitive as well. So I just want to focus on this aspect. Point number one, how much of R&D, how much of CapEx are you planning on putting into the EV segment for this fiscal year? And also, what kind of revenue ramp-up can we see from the EV segment for FY24 as well as FY25?
Yeah. So in terms of CapEx investment, as you know that the board has approved investing almost close to 600 crores in the EV businesses, be it the JV with Frevo or the JV with the Buller Motor for EV motor, also some of the EV business which we are doing as part of our controller division. So there has been a lot of EV specific business on top of it, as you rightly mentioned. If you look at only pure EV segment, so a lot of our businesses are actually agnostic to either IC engine or EV engine. From that perspective, we have been able to maintain or even actually improve some of the segments, our market share, when we move from IC to EV. So from the EV revenue perspective for FY24 and FY25, we do expect that this year, if you see, we have built a lot of new businesses. And if I see our total revenue build-up, obviously the question mark always is the industry volume. So based on whatever volumes our customers have guided us and based on which we are building our capacities, in FY27, FY26, we are expecting the total EV revenue segment to be almost like 2,500 to 3,000 crores, which includes both EV components, specific EV components, and also the components which are agnostic to EV.
One sec, just one clarification here. In the sales to two-wheeler EVs was about 300 crores in the first half of the year, right? So going by
Yes.
that run rate, you will finish at about 600 crores this year, the sales to two-wheeler EVs. So will you be able to do, you said by the end of FY26, you're planning to do over 2,500 crores, is that correct?
Yes, that's right. That's right, Sonia.
That's a huge jump up compared to 600 crores that you'll finish by the end of this year.
Yeah, because this what you are talking 600 is only two-wheeler segment. We are also present in the some of the components in the EV three-wheeler segment and also EV four-wheeler segment. So what I am saying is overall revenue from the EV segment, it is not only EV two-wheeler. That's number one. And number two, there are also a lot of new products which are getting into production as we move forward. Like the EV motors, while the plant has been ready for commissioning, it will start production only in the last quarter of the fiscal, and then you will see the volume ramp up. There are a lot of businesses which are in the pipeline. We have secured a lot of new businesses, as we say, which will get into SOP only in line with when our customer actually launches the vehicle. So there is no point in producing today and keeping in the inventory. So the production will happen only in line with when the launches are there, and that is expected to be in FY25 and something is also in FY26. So in addition to the volume ramp up, you'll also see a lot of new product addition, which will happen in the next 12 to 18 months.
Sunil, hi, morning. Prashant here. Just two questions. One, you said many of your components are agnostic, EV, ICE. Value-wise, what is that? How much would you put it down to the agnostic bit?
Yeah, so if you see our total order book, so EV specific components, and if you refer to our last quarter presentation, EV specific components is something around 1,700 odd crores.
1,700.
And 1,300 odd crores is the engine agnostic component. So total order book from the entire EV segment is almost like 3,000 crores, which is the annual value. We never talk about the cumulative value because it all depends on the product life cycle. So this is the annual peak value we are expecting based on the volumes which our customers have guided us.
Okay. Sunil, just one more question from me. Globally, I mean, so looking at some data a few weeks ago, have things for some reason slowed down a little bit? Could be just cyclical in terms of EV penetration in many parts of the world? And if yes, I mean, what's going on?
Difficult to say only from EV. Yes, there has been some analysts commenting on the delay in some of the countries in terms of EV adoption. But even if we take a step back, there has actually been some volume impact in our exports. But because we have been able to put more products into the export region, we have been able to grow our exports. But if you see apple to apple, what we have been planning versus what it is, actually volumes are a bit softer in the developed world. But as I said, because of the new product addition, be it in the switching segment, in the seating segment, we are putting a lot of focus on our exports, and that has been able to more than offset the softness in the industry. So from that perspective, we are trying to sort of maintain our export pie also as part of the total revenue.
Here in India, for example, companies like Bajaj, etc., when we speak to them, they say that after phasing out of the FAME subsidies, sales have become stagnant. So here also, I mean, it's a longer-term trend, but at this point in time, looks like we're running into some headwinds, a little bit of slowdown.
Absolutely, Prashant. If you see the EV penetration in Q1 versus Q2, because the subsidies were sort of reduced in June. So the EV penetration in two-wheeler segment specifically, if you talk about, was roughly around 4% in Q1, which sort of softened to some 3-point-something percentage in Q2. So there has been a little bit of impact. It can also be because of a lot of pre-buying also happened because the government had announced the reduction in the incentives or the subsidies. So there has been some pre-buying also which happened in Q1. So we have to see what are the numbers in Q3 and Q4 to actually conclude whether actually there is a significant softness in the demand or it's a temporary phase.
Okay. On the margins, your first half FY24 margins ended flat at about 10.9%. Given that there are plant additions, there are some new product additions, some costs are getting added as well, do you think that could put a little pressure on your margins in the second half, or will you continue to maintain it in this band of 10-11%?
So we continue to maintain the band, Sonia. So we actually have been conscious before we guided at the beginning of the year in terms of our annual margins. And whatever new plants currently are being sort of commissioned or are in the process of ramp up, the impact of that has been factored in these numbers.
Okay, so continue to maintain the margin band at 11%. Got it. I just had, since we're talking about margins, right, wanted to check on Kosei Minda, which you recently got full control of. What's the target over there in terms of growth as well as margins? And secondly, Minda Kyoraku as well. Last year, we saw significant margin contraction over there. Any kind of improvement that you've seen in the first half of the year?
No, absolutely, Sonia. So if you see, Kosei Minda was into losses for past few years, if you see the financials. And our first focus has been to turn around the business, do the operational improvements, do the capex what the business needs in terms of stabilization, in terms of reducing cost of production. And we are happy to say that the trend has been positive. And we are expecting to be EBITDA positive in this quarter itself. And going forward next year, we are expecting to be PBT positive. As far as Minda Kyoraku goes, yes, there also we have had some businesses which has been taken at a very, very competitive prices, which has impacted the margins. So there also the financial situation has actually improved compared to last year. But if I see quarter to quarter, we are expecting Q4 to be sort of PBT neutral or PBT positive. And next year, when we move on, to be significantly better than this year. So on both the businesses fronts, there have been significant improvement in the operational and the financial parameters.
Always good speaking to you, Sunil. Thanks so much for stopping by and giving us all of those details. I look forward to having a chat with you in the coming month as well. For the time being, though, we'll slip into a short break. When we come back, we'll turn our attention to Honasa Consumer. Well, they reported their numbers, which looked quite good. Welcome back. Well, let's get straight to the discussion on Honasa Consumer. The stock is up close to around 5% or to understand about the way ahead from here. In fact, now it's up close to around 10%. There was a bit of an intraday dip that's got bought into. Varun Alagh, the chairman at Honasa Consumer, joins us on the show. Hi, Varun. Good morning and congratulations on a good showing in the past quarter. Well, plenty of debate with regard to valuations. And at the IPO, you had said that you believe it's fair. And for the time being, that's proving right. The question is, what's the way ahead? Because top-line growth has been good. Though on margins, you have mentioned that there is scope for improvement. So give us a rough number in comparison to what you did in the first half of the year. What kind of margin improvement are we looking at? And add cost as a percentage of your sales. Well, that's come down to around 35%. Do you see that number dipping further? If yes, by how much?
Hi, thank you for having me on the show. So from a perspective of the way we have seen the business in the past, and we clearly see that as brands grow in scale, and there are structural efficiencies which come across marketing and the leverage that comes in, because as the brand awareness increases, and the need for similar level marketing decreases, then in percentage it keeps going down. Right? And we've also seen OPEX leverage kicking in. And as we go forward, of course, in the short term, things would be very similar to what they have been in the past. And but from a medium and long term perspective, I think our endeavor would be to keep looking for more opportunities on how, while we continue to grow faster than the market, and how we can find more opportunities of efficiency
Varun,
and leverage. And we'll keep working on the same.
You know, Varun, you've said that before as well. You're looking at operating leverage, you're looking at growth, looking at outbeating the industry growth. That's very, very good. We're trying for a couple of quantitative numbers. So in terms of an improvement on the margin front, say by FY25, you don't want to give us for FY24, how do you see that number move? Can you see 100, 200 basis points improvement? And also on the ad spends, it's come down from around 40% to around 35%. And you told us about that as well. Do you see it dipping further? If yes, what will be the ideal number out there? Some quantitative details.
I wish I could give you a quantitative outcome. Right? Of course, like I mentioned, right, that the objective here onwards would be to get better each year, right, while continuing to grow faster than the industry. Right? And like you rightly mentioned, right, the largest component of that getting better, or that efficiency or leverage that we see happening even in the next year or the next 2 years, right, will come from the A&P leverage, right? And we are very confident that will continue to sort of help the company become more efficient.
Varun, hi, good morning. Prashant here. I think the stock market's excited to see you because as we are in conversation with you, the stock has moved up a few percentage points. It's up 15, 16% now. So that's a very strong reaction to a strong set of numbers. Can you break this down, the result that you've posted, volume growth across brands? Where have you seen the maximum growth? Does it come from new brands, older brands? And what's the outlook? Really?
Honestly, the entire growth is actually volume driven. Right? If you look at our half one, right, our value and volume growth is both at that 33-34% mark. Right? Across brands, if you look at, of course, Mamaearth is our largest brand and continues to grow very strongly compared to the industry and other large brands out there. Right? But our younger brands have also demonstrated very disruptive growth. Right? The Derma Company, which is our second brand, which is just 3.5 years old, is already at a 380 crore ARR. Right? Aqualogica, which is less than 2 years old, right, is hit a 180 crore ARR. Dr. Sheth, which we had acquired last year, and we've actually grown the brand 30 times, and that has also entered a 150 crore club. And I think not many companies have been able to demonstrate the ability to scale and build brands at the pace and time that we have demonstrated. Right? And that gives us a lot of confidence on not just being able to scale these brands into much larger outcomes, but being able to do that on more brands as well.
Sure. I think that's what the street likes, 16% higher now. So you're clearly the lucky charm here. But Varun, good morning. By the way, overall your growth rate, just to get that out of the way, has been 33% in the first half of the year. Is this 30% plus growth rate sustainable in the second half as well on the top line?
That's our endeavor.
Okay, got it. So 30% plus growth rate sustainable in the second half of the year as well. Can you tell us from the offline market now, what is your share and what is the target over the next couple of years?
I think that's an area where we're still very young. And it's only been 3.5 years that we've started sort of expanding in offline. And we currently, of course, about 35% of our revenues come from offline. And it is amongst the fastest growing channels for us. And we're there in only about 150,000 stores in the country today. And I think there is a lot more distribution expansion opportunity, a lot more that we can do by just going deeper with our modern trade customers, and even opening more EBOs. Right? So on all three fronts, we will continue to double down.
Varun, the street also likes the fact, as you mentioned with Dr. Seth, you bought that business and then I think it's grown 25, 30 times odd. And now it's entered the 150 crore club. So inorganic growth will be interesting because you'll have the ability and you'll have proved that. And you're sitting on a good amount of cash as well. So can we hear something on the inorganic growth front in the second half of this fiscal? You're scouting, you've said yes, you're always on the lookout. But can we hear about something? And if yes, what could the potential size be?
So I would say two things. One, priority for us when we see any consumer white space, right, is to still attack it organically by actually crafting our own brands, because we have clearly demonstrated our ability to craft and scale brands. Right? That said, if we come across good brand mixes which we believe we can grow much faster, and we are going to look at them as well. Right? Ideally, beautiful brand mix, but not too large, right? Is a better place to be as we evaluate them.
Varun, one of the risks which there was a analyst note which was published, Jefferies had initiated coverage a few weeks ago. One of the risks they had highlighted is that between 40 and 60% of your revenues over the last 3 years that you've generated have come from brands which sort of you launched in that same year. I mean, so they are from new products, new brands. So which means that you have to continuously innovate and put together new brands and then launch them, push it to the market, etc. How do you respond to that, and how should investors read that?
So let me just correct that understanding. Right? What that referred to was our innovation-led growth. Right? And that's not just about new brands, right? But innovating within our current brands, more importantly, right? Is what has led to and has been one of the core drivers of growth. Right? As a company, we very strongly believe that consumer out there is looking for newer, better innovations and evolutions. Right? Companies and brands that are able to serve those needs, right, will actually gain, in the longer term. Right? And we have built a company which has ability to do that. Right? So I think that's our core DNA. We will continue to innovate and provide the right products to our consumers. Right? Even in H1, 13% of our revenues have been delivered through innovations that we have done. Right? So I think that's a continuous core capability of the company, and we'll keep driving that to delight our consumers.
Got it. In fact, I've been a personal user of both Dermaco and Aqualogica, and I must say you all are doing exceptionally well in that space. But these new products, right, currently I think it contributes about 13% in the first half of the year. How much do you see new products contribute to your business over, say, the next 1 year or so?
So the thing with us is that for innovations, every year is a new benchmark and a new year, right? Every year we have to look at consumer trends, what are the consumer needs. We have a lot of data crunching that we do to understand what kind of products would the consumers love, right? And we provide those products to them, right? So it's not just about what we have launched this year and how that will do next year. Of course, that is going to grow, right? But we are already all our teams are working on, going to all the markets in the world as well, studying all the Indian data and consumers, right? To figure out what are the right products to offer them in the next calendar year, which can attract their attention. So I think, like I said, it's an absolute ongoing, capability for us, right? Which we rely on every year to actually deliver delight to consumers.
All right, Varun, thanks so much for stopping by, and congratulations to you as well as the team on delivery of these results. I've got 2 little babies at home, so you know which products I'm using. But last evening I saw on social media as well, you all put out a video of the maintaining work-life balance. So good on you. I think employees will be happy. You're happy today, and shareholders are happy as well with what you had to say, because as we speak, the stock is at the high point of the day, up 18%.
So what's the trick to maintain work-life balance?
We'll discuss that after the call.
All right, well, more on that later, coming up with Nigel. Well, 18% higher, you got Honasa flying away and looking very, very strong. Raymond is the next company that we're focusing on. The stock will come up on your screen, and maybe we should look at the price on Raymond over the last maybe 2 weeks or so. From 1900 levels, the stock's come down to about 1680 or so. Raymond, the company seems to be caught in the Gautam Singhania and Nawaz Modi fire, so as to speak. To bring you quickly up to speed, Gautam Singhania announced separation from his wife, Nawaz, on the 13th of November. And the latest news flow, Nawaz Modi has claimed that she's been expelled from Raymond and has claimed 75% of Gautam Singhania's assets for herself and, of course, her daughters. What do these developments mean for the company, Raymond, and what will the board and investors look at? Are institutional investors likely to get involved? So let's talk about this. Hetal Dalal is President and Chief Operating Officer of Institutional Advisory Services to take us through some of this. Hetal, good to have you with us here. Good morning. It's a unpleasant saga which is playing out. And of course, it's tough to miss. It's now kind of coming out in the open. Lots of outlets reporting on it. What is your first reading from a investor listed company point of view? Will the board get involved? Should the board get involved? Go on.
So thank you, Prashant, for having me. But these are unfortunate circumstances. Nawaz Modi has accused Gautam Singhania of domestic violence, and that has resulted in impact on the stock price. Now, if you see what she claims is all of this started in September. These events took place in September. We are now in November. The board has been silent till now. You could argue that there was a reason to be silent. Right? It's a personal matter. The daughters are involved. It's a woman involved. So therefore, discretion is required, and therefore the board could be silent. That's one argument to make. But we don't really know what the board has done or is thinking at this stage. I think now that has begun to impact the stock price, it is incumbent upon the board to provide clarity on what is the way forward and what they're seeing. See, at a very basic, the board now needs to at least provide some kind of assurance to shareholders that despite all of this happening, the company is still under reasonable control. Being silent is no longer going to help. So I would argue that at this stage, given that all of this has become public, Nawaz Modi's gone public with these accusations, it has impacted the stock price. It is all the more incumbent upon the board to articulate what it has done in terms of an action and allay some of the fears that the market seems to have given this entire acrimonious situation.
Way or form could that be, Hetal? I mean, what could the board do? I mean, could it ask for an explanation from Gautam Singhania? Could it order some sort of an inquiry? I mean, is the board well within its rights to do so?
See, I mean, ideally to look at the situation, the board should run an independent investigation. It should ascertain what the facts are, whether, what Nawaz Modi is now talking about, there are legs to it and there is a factual basis for all of it, what actually transpired. Based on that, they have to then decide what is the course of action. Now, they have a couple of questions to answer. One is to say that, is this necessarily in line with the company's code of conduct? Are they able to disassociate the brand? Assuming this is true, are they able to disassociate the brand from the problem? Third is, at what is the action or consequences of such behavior, assuming that this behavior is true. So it's not an easy task for the board, but at the end of the day, there has to be a kind of action that the board will take, which will also be a signal to the market in terms of what is considered acceptable behavior and where does the board draw the line.
Hi, Hetal. Good morning. Nigel on this side. Good to have you in. Hetal, could it be possible that the board takes a decision that, till the dust clears out, or because, the lady in question has claimed that, she's been ill-treated, could they ask Mr. Singhania, you step aside for now, and till everything clears out, then you come back? Is that something that the board can consider?
Ideally, without an investigation, taking one side is really not necessarily the best way to go. I mean, board could ask both of them, for that matter, to step aside and say that, put in an interim CEO until their entire dust settles. To take it on to one side and simply say Nawaz Modi should step down or, set aside without the other side of the implication, I think is a bit unfair, or at least jumping to conclusions. But I do agree that given the current situation, there is likely to be a concern in terms of the efficacy and smoothness with which the board will function, or board meetings will be conducted and function. So I think this is far more complicated in terms of, it's not isolated in terms of saying that this is a domestic matter. It's clearly reached the company and both of them are on the board. So therefore, the board needs to step in. Logically, yes, maybe the board decide both of them take some time off, so to speak, and they figure out how to settle this matter and therefore separate the company from the public.
All right. Hetal, when we talk about what the board could do, this is also the promoter, the person in question is the promoter plus the operational head in that sense, right?
Yeah.
So it would have been different if it was just the sort of professional CEO who was perhaps under the scanner about what this was all about. So does that kind of change things, how one needs to assess the situation? The fact that this is the promoter we're talking about.
It does. Look, in India, at least our experience has been that boards tend to be a little bit more easy with promoters than they are with professionals. But having said that, let's separate the two, right? If you separate the ownership from the management and say that he is effectively the CEO, then you have to ask two questions. Is he a hands-on CEO who goes to the plant every 3 days and knows the names of all the workers and all the supervisors? Then yes, it's a little bit more difficult to look at an internal position. But if he's a strategic head providing broad guidance, there are a bunch of professionals who are managing the business on a day-to-day basis, then the decision is a little less complicated than otherwise. But the fact that he is a promoter does complicate matters, and it is now for boards to therefore step up and say that these are that this is where they will draw the line based on their sort of investigation. See, and companies go through this whole dispute, right? Whether it is a divorce, whether it's like legacy issues, whether siblings are fighting, family is fighting. There's three things which tend to happen. One is that all of this becomes a distraction for the CEO. Assuming the CEO, the promoter. The second is that there is effectively some kind of a separation, some kind of parting of voting rights, and that changes the voting pattern. And the third is it would effectively change the risk appetite of the CEO after a split. So it is definitely complicated. There is a divorce on the anvil, and therefore there is this entire situation will drag out for a little bit longer than we expect, is what we think.
Well put and well explained, Hetal. We'll sort of leave it at that for now, but this is something which we will keep coming back to and discuss this with you as the story develops and the situation develops. Thank you very much, Hetal, for joining us and providing some clarity on what may happen from here for viewers who are watching, for stockholders and Raymond, etc. Well, 35 points on the Nifty. We're at about 19,845. So things are looking quite okay. I mean, just maybe with 1 hour done, almost 1 hour done, market breadth is positive. 1,140 stocks are higher and about 940 stocks are lower. So it's not a big gap or anything, but it's looking good. And just one word on Honasa, which is now actually locked up. It's limit up, 20% on Honasa. We just had the management of the company with us, and the stock's up $70, 424 on Honasa. That's also coming up as one of the large volume traded names. I mean, actually, it is the largest volume traded name with what it is doing on the price as well. We'll come back. Mitesh will be with us for a quick technical check on the market. Stay tuned. More coming up.
Welcome back. Well, for now, the market is, it's actually not bad. The index may look flat, but there are plenty of stocks which are moving around quite a bit. The auto space is really on fire this afternoon on the this morning on the upside. So something like a Bajaj Auto is up almost about 3% now. The management was very optimistic yesterday. More on that later. But Mitesh Thakkar is also joining in now to, to give us more details on all that he's looking at. Mitesh, first on Bajaj Auto, any thoughts? It's at 5,900 now, new high over there. Any more technical levels that you're watching out for on the upside, and what else?
Yeah, actually, Bajaj Auto, I think, has met all the targets which we had listed. I think, the stock has actually surpassed them. Well, the only thing I can suggest is keep your stop loss at about 56.75 and, try to hold the stock. No idea where the target would be. So till a reversal happens, it will be very difficult to make a fresh view or a comment on the stock chart. But that about the stocks which I'm tracking right now, I have a buy on Quest Corp, very strong breakout taking place over there. So buy here with a stop at about 504 and a target of around 550 can be looked at. And the other one which I like is UPL, which I would recommend buying with a stop at 560 for targets of around 590.
Okay, thanks a lot for that. Well, now let's get you an exclusive. Bajaj Auto, as we told you, is one of the big stocks that's moving around. The CEO, Rajiv Bajaj, has said that the company hopes to launch the world's first CNG two-wheeler in 2025. Speaking to my colleague Parikshit Luthra, he said that the company expects the sales of Triumph bikes to double to 18,000 units in the third quarter. Bajaj Auto and UK's Triumph Motorcycles have entered into a partnership to manufacture premium bikes. Bajaj also said that the two-wheeler industry has not bounced back from the pre-COVID levels just yet, and the sector suffered from over-regulation and taxation. Listen.
We are taken a little bit by surprise, I must admit. We had prepared ourselves for 5,000 a month because, primarily the market leader there, Royal Enfield, is a very tall and very deep brand. All of us have tried over and over again in recent years, but nobody's really been able to make an impact. So our initial capacity, as I had shared with you previously, was for 5,000 a month. And yes, last quarter we have done, I think, 8,000 totally. This quarter, I think we should more than double that to about 18,000, which means an average of 6,000. So out of a capacity of 5,000 a month, we will hopefully be able to squeeze out 6,000 Triumphs on an average every month this quarter. I guess the next logical step for Chetak is, I would say, 20,000 a month for let's say 20% share. So 2020 should be the next stop for Chetak. We have again an exclusive network for Chetak, and we have to grow that network, and we are working on that. There are still some large markets where we are underrepresented, and finally there has to be excitement for the consumer. I'm happy to say that very soon, by which I mean as soon as perhaps next month, you will see some new products in the marketplace under the Chetak brand. We are in very early stages of the game. So what I'm prepared to say today is that this is not something we are about to launch, in this year or something like that. But I'm prepared to say that within the calendar year 25, which means within the next 2 years, we would certainly hope. I would not say we have decided to, but we are very hopeful of launching this motorcycle. And let me tell you why primarily, Parikshit. There doesn't exist a CNG two-wheeler in the world today, to the best of my knowledge, unless, there is some jugaad stuff happening somewhere, as there is in India also. I'm told people retrofit. Our industry and two-wheelers in this country has really suffered in recent times, not so much because of the COVID lockdown, not so much because of commodity price increases, not so much because of the chips and chip shortage, as it has for the fact that it is over-regulated and over-taxed.
Okay, I think over-regulation and over-taxation has been a concern for the two-wheeler market for a while. And, Bajaj Auto stating that, and also talking about the big plans in their own business. But let's get back to some of the other stocks. Cipla is in focus. Vivek is here to give us the latest on that. Vivek, what are you picking up?
Well, absolutely. Now, Cipla is, one of the top drags as far as the market is concerned today. What's actually happened is that, remember, on November 18th, the company informed the exchanges that they had received a warning letter from the US FDA for the Pithampur unit. Yesterday, the US FDA uploaded the warning letter to the website, and post analysis of that, it does appear as though some of the observations in the warning letter are quite serious, and this is what is dragging the stock lower. Let's have a look at some of the key highlights of the warning letter. Number one, the US FDA has highlighted that data integrity issues persist as far as this particular facility is concerned. They have spoken about issues both in product compliance as well as microbial contamination. The second point that they've highlighted is that both Pithampur as well as Goa are seeing similar as well as repeat observations from previous inspections. Remember, even the Goa facility is now under the warning letter. And thirdly, the US FDA has gone ahead and advised Cipla to go ahead and onboard third-party consultants to address these issues. Now, when you're talking about the timeline of events as far as Pithampur is concerned, remember, February 2023, the US FDA inspected this particular facility, issued 8 observations, and then classified the facility as an official action indicated, which had given an inkling to analysts saying that, this particular site or this particular facility could be come under the warning letter. Now, going forward, this is a bit of a setback to Cipla. Remember, 2 important products, generic Advair as well as generic Abrixon, are both delayed. So these launches could be pushed out to FY25. And along with that, it remains to be seen whether there is any escalation of worries or of the status at Pithampur itself. It's a significant contributor to the US revenues for the company.
All right, we'll take a quick break on that note. On the other side of the break, our special segment, Indianomics, Lata will get chatting with Santanu Sengupta of Goldman Sachs to discuss their latest report of the Indian market. Stay tuned.
Welcome back in our ongoing series Outlook 2024. Yesterday, we heard from Timothy Moore that Goldman Sachs has moved India to overweight and expects 21,800 on the Nifty next year. But what about the Indian economy in 2024? I have with me Shantanu Sengupta, Chief India Economist with Goldman Sachs, for just that. Shantanu, thank you very much and for dropping in our studio. Well, first up, the big number that's coming up is in a week. The second quarter GDP number, RBI's estimated 6.5%, and the governor hinted it may be more than that. What are you going with?
We have a slightly lower estimate than where consensus is. We are at sub 6% for growth for the second quarter, calendar year third. We think that it will be dragged down by mainly two factors. One, you had the uneven distribution of monsoons. Two, inflation was very high, which could pull down disposable incomes. We think that in the current quarter, that is the third quarter of the fiscal year, growth will rebound, helped by subsidies and transfer payments from the government, and also some bit of festive season consumption spending.
Okay, no, fair point. We'll hold you to that when the numbers come. But even for the full year, you are standing at 6.2% fiscal, whereas RBI, I think, is at 6.5%. Is there an upside risk, or do you think that 6.5 is too optimistic?
We think, in our view, the risks are more or less balanced around 6.2. I mean, sure, if you get a little bit of more impetus from government spending in the current quarter and in the next quarter, you could have growth pushing higher towards 6.5. Whereas, if you have more headwinds from consumption growth, and you've had consumer companies not reporting great numbers in terms of volume growth, etc., which is where we think the drag will be a little bit in the current year.
No, even I found it a little difficult to share the governor's exuberance, though some of the economists we called did think that there could be an upside risk. See, there is this further Reserve Bank move to tighten risk weights on consumer lending. Did that make you change the number? Will it have a macro impact, or is it too small?
We think it is too small from a macro point of view. I think the RBI was very judicious in increasing risk weights and hence increasing the price of loans in that segment, rather than increasing interest rates, which is a more overall impact on the economy. So more than the economy on aggregate, we think it is that segment which gets impacted. It was in any case growing at a very sharp clip. And therefore, as a regulator, probably you would want to slow that down a little bit.
No one faults the RBI. I think they got a lot of kudos for that. It was just, you don't think there's a macro impact?
Yeah, not at this stage. We do not think it's a macro impact unless there's a contagion. Okay. But the contagion is exactly what the RBI is trying to prevent against.
Stop the banks to NBFCs to consumer lending. Okay, the other thing about your report which intrigued me was the rupee. You're expecting an appreciation of the currency next year?
Yeah, so our view is, overall it's a flattish rupee. I think the near term we are expecting a little bit of depreciation because the dollar we think will be slightly stronger in the next 3 to 6 months, which takes it higher towards 84. But over the medium term, that is a 12-month horizon, look, our view is that the dollar will sort of peak out as the market starts pricing in Fed rate cuts in the second half of the year. And the reflection in the rupee is basically the dollar view. But overall, I would point out that, one of the parts of the macros, which is looking really stable for us, is the current account deficit. We think it's going to be around 2% of GDP or probably lesser. You're having these tailwinds from fixed income flows next year due to the bond inclusion. Equity markets, we have, raised to overweight. FDI, we think, will be tepid, which is what has been baked into our forecast, around maybe 1% of GDP. But overall, it looks like the current account will be well funded. And the RBI has been very active in terms of, keeping rupee range bound. And hence, the 12-month view is more a reflection on the dollar rather than the rupee leg of the currency.
No, I take your point. But, the Reserve Bank has had its own way. It has not allowed the rupee to depreciate when the dollar was strengthening. It came in on the other side. And now when the dollar has weakened, it's not allowing the rupee to strengthen because, it's allowing the pent-up depreciation, perhaps. No, where I'm coming from is I'm just trying to play devil's advocate that the Reserve Bank seems to be in favor of a slightly depreciating currency. Plus, as you pointed out, FDI has been pretty weak all over the world and into India. Services exports, you also point out in your report, has peaked off. So isn't there a greater case for 83 to 84 rather than 81?
So 83 to 84 is happening in our near-term horizon.
Your first
Again,
half.
when the dollar, in our view, remains slightly stronger, as the market still tries to figure out what is happening in the dollar rates market or the Fed funds rate path. We think by the second half of the year, the market will be more convinced that the Fed is going into an easing cycle. We think it is going to be in Q4 of 24 calendar year. And that is when, in our view, the dollar peaks out and starts weakening, which is a reflection, therefore, coming in the INR view. And you would see that in all our forecasts across the Asian pack, the Asia FX is also appreciating.
Okay.
And in line with that, the INR is appreciating a little bit, probably other Asian FX more.
Okay. All right. I guess interest rate differential, everything will work in favor of EM currencies. Fair enough. Which brings me back to the Reserve Bank. What are your expectations in terms of inflation? Is it a 4-point something next year? Do we get at least closer to target? Rate cuts? What are the expectations?
No, so we do not think that we go to 4% next year. We think that we remain at...
Not even 4 point something.
Yeah, we think we remain close to 5%. In fact, in the current quarter itself, if you see what is happening with onion prices and now tomato, we think you go towards 6% on inflation headline. So we have a 5.7% forecast for the current quarter. We remain around 5.6, 5.7 for the first half of the next calendar year as well. And only in the second half, you'll have the base effect from the quarter gone by, which will drag it down towards 4. But our point is that there are these repeated food supply shocks, some of these oil supply shocks. The governor has alluded to that in his policy statement as well. Along with that, we think that WPI manufacturing inflation has already bottomed out and turned. And we have empirically found that that feeds into CPI core goods inflation with around a 6-month lag. And hence, we think that CPI core goods inflation will also bottom out and start inching higher maybe in the second half of next year, which therefore means that for us, core inflation is at around 4.5. With core around 4.5, it's very difficult to have a convincing view that you're going towards 4% on the headline, given the repeated shocks that you're seeing on food. Okay. And hence, our number is closer to 5% for the whole year.
So not much by way, how much of rate cuts and when? Does it happen in 24 at all?
We have a very shallow rate easing cycle baked into our forecasts. We think that there's 25 basis points of rate cut in Q4 of calendar year next year. That
Q4 is the calendar. So September, October, November, December.
October, December of the next year. And then 25 more in Q1 of calendar year 25. So essentially in the second half of the next fiscal year, you have 50 basis points of rate cut only in our view. But I think more importantly, the RBI, given these repeated supply shocks, they remain hawkish. Liquidity remains tight, and therefore you have the overnight more closer to the MSF rather than the repo.
Okay. Well, let me come to the FY25 growth forecast. You have a 6.5. Do you expect private capex to pick up? Because clearly the government has to slow down its own capex because it has to bring down fiscal deficit.
Yeah, that's exactly right. Our view is that the government slows down the growth rate of its own capex. Our view also is that the second half, probably post the election uncertainty is over, you have a pickup in the private capex. Again, so this is something that we've been talking about for the last year.
But not much evidence is there.
But, from the supply side, at least, bank balance sheets look very well capitalized. The manufacturing sector balance sheets are deleveraged. There is this China +1 tailwind that is going on. And all of that makes us relatively optimistic that you can have a recovery on private capex in the second half. Remember also that, overall investments in India, when you look at GFCF, you have the government component, you have the private capex, and you have households. The households is driven more by the real estate cycle, which we think that the real estate cycle is on the way up. And combined with the real estate cycle and private sector capex, we think that investment growth in the second half can be relatively better.
Okay. Just a final question on, this potential for India. Does it remain at 6.5? Fitch made a strong point that potential growth in India and in many other countries is lower than what it was in the previous decade. Do you think it can continue at 6.5 or even better?
So firstly, we don't think potential growth for India right now is at 6.5. We think it's closer to 6%. But we think that by the end of this decade, if we are doing the right things in terms of especially investment growth and investment rate, which is investment as a share of GDP, goes back to at least half of the previous peak levels around, let's say, 34-35% of GDP, we think that can add about 50 basis points to potential growth. We can inch towards 6.5. So right now, if you see in our forecast, we have baked in, very early 6.1 as the potential growth. And yeah, we are not in the 6.5 camp yet, and we can get there if the right things are done on investments.
That's a sobering analysis, Shantanu. Thank you very much for that. Timothy Moore did point out that profit as a share of GDP is growing, and from 5%, it can go towards 8%.
Which is a great point, because empirically we have found that operating profit increases ultimately help in capex cycles on the private side. That's what you saw in the 2004 to 7 cycle.
Absolutely. So let's hope that something of a repeat of the 2004 to 2000 cycle is possible. We're all betting on that, but the big takeaway from Goldman Sachs, we are going to inch towards that 6.5% potential GDP growth, and for the index itself, 21,800 sounds reasonably mouth-watering in the next 12 months. Wrap up on this edition of Indianomics. Thanks much for watching. Chartbusters up next. And today's, okay. And the break, yeah. Okay, 21,800, that's the big takeaway for me from Timothy Moore. Thank you very much, Timothy, for joining us. Up next, we will be speaking with the Goldman Sachs India economist, Shantanu Sengupta, coming up after the break. Yeah. Or I can do it. Keep it. Shantanu, just sit down for a minute only, huh? Nothing much. I'm joining you. Or you can wait there. Either ways. Welcome back. We heard from Timothy Moore that Goldman Sachs has moved India to overweight, expecting 21,800 on the Nifty. But what about the economy in 2024? I have with me Shantanu Sengupta, Chief India Economist with Goldman Sachs. Shantanu, thank you very much. First up, the big number that will come out is the second quarter GDP. The governor has said it will be better than the 6.5%. What's your number? Yep. Thank you very much for that, Shantanu. On that optimistic note that India will get to the 6.5% potential growth in this decade, and the Nifty itself in 12 months, 21,800. That's the Goldman Sachs view. Thank you very much for joining us on Indianomics. Thank you.
Honasa Consumer rallies locked in upper circuit on the back of a strong second quarter earnings. Revenues up 21%. Importantly, the margins have expanded and the net profit has nearly doubled. The management says their endeavor is to sustain more than 30% of growth in the second half of this year.
IEX surges over 3% after UBS remains bullish on the stock. With a buy call, they raised the target price to 200 rupees a share. The brokerage says that the key triggers ahead are improving supply situation and softening merchant power prices.
Home First Finance slumps after 9.8% equity worth nearly 754 crore rupees changes hands at around 872 rupees per share in a block. The stock is now down over 2.5%.
CE Info Systems surges close to 3% on news that the board will be meeting on the 27th of November to consider a fundraise.